and join us today. Scott is our Vice President of Renovation Lending. He brought Renovation Lending to SWBC. Some of you were at the meeting the other day, and I talked about how these products have been around for a long time. Just a lot of companies have not put them to use, have not wanted to tackle them, didn't really have the wherewithal to do it. And we went through the big foreclosure and kind of some of the slowdown here, and a lot of our lower end price homes were the ones that were getting foreclosed on. And remember, the people were stripping everything out of the homes. They're taking all the copper and pulling all the fixtures, and I was like, man, we need this product. And so SWBC was kind enough, prior to Scott coming, to go out and get it, but we had to sell it through an aggregator. So that means we had to sell it to somebody like Chase or Wells Fargo, which is, you know, adding a middle person into it. Even though you get to underwrite it, you get to do all these great things, you still have to clear everything through Big Brother. And so they went out to a company named M&T, big bank on the East Coast, right? Mm-hmm. And they brought us this product, and I looked at it and I said, there's not a chance in hell I'm going to even try to do this. So we just were like, thanks, but no thanks, and I'm sorry you went through all that work to put it all together for us. And then fast forward, they bring Scott in, and Scott, a lot of you guys might have remembered First Horizon, right? First Horizon
and CTX.
And CTX. He ran all that, so he's had a lot of experience putting this stuff together. So he came in and put our 203K, the limited and the full, what's that called now? Standard now. 203K standard together, and then also the home style renovation. So the beauty of it, even though the products haven't really changed that much, and they've been around a while, the beauty of it is that we handle it all internally at SWBC. So when we tackle one of these projects and we run into a problem, we just call Scott up. He got a cell phone number, and he's going to take care of the problem for us, or at least guide us into what we can and can't do. And we don't have to worry about trying to call a call center at M&T Bank or Chase and go, well, this is what it said, why can't we do this? So anyways, thanks for coming down from San Antonio. He came down today to present this for us, and thanks for being here. And Scott, take it away.
Rock and roll. All right, guys. So we'll keep this pretty open, so you guys ask as many questions as you want. That's kind of what I want it to be like. I got a deal up here to kind of walk us through so I don't miss anything. But you know, essentially what we're going to do is talk about the programs, talk about the fact that we do offer them in-house. It is a product, both of these loans are done through either FHA or Fannie Mae, and we retain the servicing on this. So this is not a program like Jeff said where we'll actually sell the loan off to somebody else. We're actually hanging on to this paper. These customers become part of our family, just like you guys are part of our family, and we sit there and work with them for the next how many ever years they stick around with us, hopefully forever. So let's go ahead and get through a little bit of this. We'll talk about some of the stuff just in the renovation world before we dive into the products specifically. But let's talk about the fact, does anybody monitor what goes on with the renovation world? The answer is yes, that the National Association of Home Builders actually monitors all this stuff and kind of keeps track of what's going on in the renovation world. They started doing that aggressively in like 2007, 8, and 9. Primarily because nobody was building any houses anymore, so they kind of had something to do. So they started monitoring the renovation world. They break renovation monitoring into 3 categories, which is major additions, minor additions, and maintenance and repairs. Major additions, of course, are anything greater than $25,000, and then minor is less than $25,000, and then your maintenance and repairs is just kind of what Jeff was talking about, fixing up the foreclosures and those things as they roll through the marketplace. In the major addition category, what we're seeing is 30% of the remodeling activities is that of major additions or alterations. Now, I totally assumed, being in this business for a few days, that after the flood of REO and foreclosures kind of worked its way through the marketplace, that this business would kind of dry up a little bit, and there wouldn't be quite so much of it. And I very rarely am I wrong, unless you ask my wife, who tells you I'm wrong quite frequently. I was wrong about this, that we actually are experiencing greater growth in all segments of it. There can be some thanks to that to our friends over at HGTV and DIY, because they're pushing the products tremendously, and everybody's kind of into it right now. But as you can see, in the fourth quarter of 2015, owner occupancy significantly surpassed rental properties, being 62% of the overall major addition category. And if we go into the minor addition category, owner occupied is 64% of that segment. That used to be non-owner occupieds were the big piece of it, while the whole REO world was funneling through the system. So it was investors buying houses, doing major minor additions and stuff. Now it's actually moved in, and the owner-occupied segment has highly taken over. Maintenance and repair side, it's 30% of the marketplace, and even in that section, 60% of it is owner-occupied on maintenance and repairs. Calls for bids are at the highest level since 2001, because they track that as well. Work committed for the next 3 months is at the highest level since 2004, and the backlog of remodeling jobs is continuing to rise. There's a reason for that. We're going to get into this problem now, or we're already there, of not having enough guys to do the work. You know, guys got out of this business after the fall of the construction business, and really they kind of left the business completely. And then new guys didn't come into it because they didn't hear the great stories about all the money they could make being in a trades type business. Now we are seeing a little bit of help right now because a lot of our oil field workers are migrating into the construction segment, because a lot of them had that skill set and they went into the oil and gas business, and now that that's kind of fallen down a little bit, we're seeing them migrate back in, which is great, and that'll help a little bit. The other problem is materials. Materials aren't keeping up. Many of you, if you were in the business in the mid-2000s, there was a great shortage of drywall at one point, to the point where we imported drywall from China. We got into this Chinese drywall issue, which I'm doing renovation loans right now to abate Chinese drywall out of houses in the South to go ahead and get it removed, but we're experiencing that. If any of you have paid attention to the big deal going on with the flooring industry, Lumber Liquidators is in a huge mess right now over Chinese flooring that has formaldehyde in it, that is increasing the levels of toxins in the home. The FDA released a thing the other day which I thought was awesome. They told people that had put the flooring in their house that they miscalculated it originally because they assumed everyone had 10-foot ceilings in their homes, so that the rates of toxins in the home weren't that bad. They came back and recalculated and said, no, the average size ceiling in a home is around 8 feet. So now the FDA's formal announcement to help relieve the home from toxins was open the windows more often. It wasn't take the flooring out. It was open the windows. So I think we're going to see more issues like that. There'll probably be more controls put around some of these materials that come in and are manufactured. And with that said, more delays, more things like that happening. So we got to keep that kind of on our radar. Appointments for proposals are increasing greatly. And again, we got to thank HGTV and DIY Network for all this. I don't know what you guys do on Saturday and Sunday, but that's kind of what I do. Sit around and watch those shows all day long, and then I go try to do stuff myself. Not very good at doing anything. So there's many halfway done projects on my home that I'm probably going to have to hire a contractor to fix. Let's look a little bit. Metro Study put out a graph on what the remodeling industry has done. This is as of October of 2015. So you can kind of see that the lines have gone down in 2009, 10, 11. It was kind of stagnant to the bottom, but now we've ramped up and we've gone higher. This tracked it all the way back to 2004. So as you can see, it's becoming a big piece of the marketplace and predicted to do so. Our friends over the National Association of Realtors released this that said in 2016 they anticipate 1 in 3 homes sold will have some sort of renovation work that needs to be done in the home. They even went as far as to do a 2015 remodeling impact report that they did with NARI. If you haven't seen this yet, go on the association's website. You can pull it down. I screenshotted a few screens here for you just so you kind of look at what they did in the presentation. As of October, Americans had spent $326 billion on remodeling. And after remodeling, 74% of the buyers and owners they said they had a greater desire to stay in their home. That's good and that's bad, right? So that's less people willing to sell, but the people who are buying are more apt to buy and want to stay in the house and get some.
Well, that's why the realtors need to know about this, so they can say, "Oh, yeah, you could do this, and we can have buyers come in and buy your home, and they can take part of this program, and you can go buy one that's already done."
They show the difference between on interior projects of what's appealing to the buyers. So they did a realtor rank the projects appeal to buyers highest to risk, and then rank the likely value to the home for resale. So if they do these projects, what they'll gain most lift out of. Kitchen upgrades, number one. Across the board, then bathroom renovations, and then we get into things like flooring, HVAC replacement, and then in areas where there's basements, there's basement or finish outs and those kind of things. But if not, the report's done really well, and I kind of urge you to go out and take a look at it. Let's look at, just for instance, Master Suite. If you go into the new Master Suite, Owner's Suite, the top reason for doing the project was to add features and improve livability. That was 27%. But 88% said they have a greater desire to be in their home after completing the project. And that's pretty huge. And when we get people that are coming in talking to us and we're thinking about, you know, what does your budget look like and what can you afford and those kind of things, a lot of people have built into their budget what they spend. You know, going out, money that they use going out to eat, money that they use going out to visit with friends and family. This is the kind of numbers that you have to really get into and look at. Even on a kitchen upgrade, 82% said they had a greater desire to stay in their home after completing the project. Well, what does that mean? That means less money spent out eating at a restaurant, more time entertaining at home. People will begin to migrate in home. We don't see it in Texas quite as much as we do in other parts of the country, where people are spending more and more time in their homes, in their kitchens, entertaining in their homes. But I think that's eventually going to happen here. Again, Realtor Magazine constantly putting out articles, home renovations make pre-recession gains, adding home renovations to your business. If you don't, as a realtor, have this renovation piece added as part of your business plan, you probably should think about it, because again, if we go back to that slide earlier, where 1 in 3 homes is going to have some sort of renovation or repair tied to it in 2016, it makes sense to go ahead and add it into your product mix, or you're going to kind of be leaving a few dollars laying on the table. Let's talk about how borrowers finance these improvements. I mean, I did a home and garden show 2 weeks ago in Arkansas, which that was interesting. First of all, the biggest seller at a home and garden show in Fort Smith, Arkansas, is tornado shelters. Shocker. But I mean, they had this giant tube thing that you got in and closed the door, and it was metal during the tornado. And the only thing I kept looking at that thing and I go, there is no way I'm getting in that thing during a tornado. I kept thinking about that blender bottle thing, you know, that you have in the morning when you shake up your shake. And I'm like, if I'm in that, I turn out looking like goo when it's over with. There's no way. But we talked a lot about, we did this presentation at the Home and Garden Show for the people that were coming in. And this really hit home with a lot of them was, why would a borrower want to finance these things through their mortgage? And again, we're still at very historic low interest rates from a mortgage cycle standpoint. And the other options really aren't super attractive. You've got credit card, installment loan, or home improvement loan. But we do get pushback from the consumer, which says, hey, you know what? Adding the cost of the renovation into the mortgage, I'm stretched enough. I stretched it out as far as I possibly could in order to be able to buy this house. Adding it doesn't really make sense for me right now. I'll do it at a later date. We'll save some money, we'll be here a year, and then we'll do these things. We'll try to do it on our own. And ultimately what happens is they never do it. They never turn the house into a home. And if they do go do it, they pay more for it. So let's look a little bit at what we've got. So let's look at some numbers. Home purchase price of $150,000. The down payment of 5% is $52.50. So now we're at a loan amount of $144,750. If you say, for instance, did a FHA loan, that's what I did the equation on, down payment wise and rate, we were at 3 5/8 when I did this slide here a couple weeks ago on a 30-year fix. So you're talking $660.13 for the payment. And now let's go ahead and add $25,000 worth of improvements. So that could be flooring. That could be flooring and countertops. That could be new roof. We do a lot of that. Windows, doors. We've done, down here we've done windows, HVAC, doors, roof. Several projects of that nature. We're just now doing a swimming pool, which is a little bit more than $25,000, but still doing it. You've increased the down payment to $55.87. So our loan amount's now $169.14. The rate ticked up to 3.875. So the payment's at $796.64. But what did that equate to? It increased their down payment by $337. They added $25,000 worth of work, but we increased their down payment only by $337. We increased the monthly payment by $136.51. If they had gone out and done it on a credit card or installment loan, that loan would have been at 18% if you went through Lowe's or Home Depot or something like that. And the time to pay off would have been 198 months if you made the minimum payment only. And that first month minimum payment is $1,000. Now that thing slides on a scale, right? With your credit cards, the minimum monthly goes down as you make payments over time. But month one, it's $1,000. And again, 198 months to pay it off. Also, if you did it, say for instance, on a home improvement loan, go down to Chase, B of A, wherever you bank, they're at about 6% right now. So you're talking $210 a month versus 136 and 180 months to pay it off. So guys, I mean, this is the better opportunity for the consumer. And we don't even talk about the fact that there's a tax deduction also associated with this. They've got mortgage interest by adding it into the loan that they get some additional tax benefits from doing. So I urge you to demonstrate that to your customers and kind of show them what it looks like. There's a remodel that was done. This was about $25,000, and we went from on the left to on the right. And I don't know about you, but I'd rather be having my meals on the right than on the left. In fact, what I'll do is I won't have a meal over here, and I'll be down at Perry's, or I'll be over at someplace else drinking a good bottle of wine, and I'll spend way more than $136 a month to stay out of there. So again, worthwhile to go in and do. Touch a little bit on, and I don't have it in this presentation, but I want to touch on it verbally. There's some good opportunities for you guys to go out and look at your stale listings. And I know stale listings isn't a huge issue right now because we're in a market that's on the lift, but every now and then you're going to get a stale listing. You know why it's stale. You walk into the house and you look at it, whether you're a selling agent or buying agent, and you can look in 5 minutes and know what it is. We in the mortgage business, we can figure it out, and if we can figure it out, anybody can figure it out. It's whether it's the flooring's bad, or the kitchen's bad, or something aesthetically is not right on the front of the house. Several of our branches have started going out. The mortgage guys are going out with the realtors to look at the stale listings. Walk the house, kind of see what's going on with it, and then go get a contractor to give some bids for improvements and kind of step it up. And then put something together that's on the counter that shows people, hey, we know this kitchen is not, if you made some changes to this kitchen and did this to it, this is what the cost is going to be. And to add to that, because people are very visual and they need to see something, if you go on HGTV's website, you know how those property dudes and the Chip and Joanna Gaines people and all that, they show them what the house is going to look like when they're done with it on the little software screen? HGTV sells that software, and it's like less than $100. And you can actually go in and show people, hey, here's this kitchen, and let's lay in new countertops, and let's lay in new flooring, and let's change the color, let's change the cabinets, and show them, and put that together with a bid. And maybe we move a stale listing a little bit faster. And maybe we can get something done a little bit quicker. I think it's just showing the potential buyers what the home could look like, instead of just, they walk in, they look, oh, this kitchen's terrible, and boom, we're in the car and we're off to another listing. I mean, I just think it makes more sense to try to find those rough gems, and that's what HGTV and DIY is all about, is finding those houses that just need a little extra love. And there's quite a few of them out there right now.
Hey Scott,
Yeah.
Can you do this on a home if the seller wants to go ahead and make the improvement?
Absolutely.
How
Yeah.
does that work?
We do it, they have to do a refinance with us, and then we go ahead and refinance them in and make the improvements
So you
that way.
refi the whole loan?
The whole loan.
Okay,
Mhm.
I got you.
Even while they're trying to sell, so they don't have to come off the market?
I don't think they would they?
Yeah, they would have.
They would?
Yeah.
Yeah, for
They
the
can be
appraisal
on the
purposes,
market.
that's right, yeah.
Do they have to stay off the market for 6 months or something?
No.
No, not anymore?
And what if they have already moved out of the home? Would that
That would hurt us a little bit
Yeah.
because you're claiming it's owner occupied. You're
Yeah.
trying to get the best rate you can.
Yeah.
Although we do these loans on like second homes and things like that, we're going to get into some details on that. We don't do it on investment properties.
Okay.
Okay.
It could be, you could do it on listing appointments where they're not planning on listing right away, but you tell them this is what needs to be done and this
Yeah,
what
when you
can
walk
be
it, you
done.
kind of know what's going on.
Right.
You kind of walk through and you look at it and you can kind of see what, I refer to them as tired. They're not exactly, terrible, but they're tired sometimes. And especially some of the homes that, you see it right now of folks that have homes that are in that 20-year-old, 15-year-old cycle, and they haven't done a whole lot of updates to it because it was good enough. But there's a lot of cool stuff out there right now, and people want some of that cool stuff. So it really makes a difference when you freshen it up. I recently moved from Park City, Utah, down to San Antonio, and we had our home there. For those of you who don't realize, Utah is a Mormon-based state, and I'm not Mormon, which didn't fit well for me. And every home has at least 7 bedrooms because people generally have a lot of children. So we had a 3-story, 6,000 square foot home with 7 bedrooms. And I was adamant about wanting to turn one of the bedrooms into a wine cellar. I'm a wine guy. So I, went through all this work, redid this bedroom, turned it into a wine cellar, did slate on the floor, had custom wine racks built. It was great. I almost couldn't sell the house because of the wine cellar in my home. In fact, we had to ultimately take it back and put it back the way it was in order to be able to sell it. And once I put it back the way it was, we'd been on the market like 60 days and really hadn't had an offer. I took it back to a bedroom, put everything in storage because I had it shipped here, and then we got 4 offers the first week, all over list. Wow. And it was all just because of the way that room was done. Wow. And it's crazy. Yes, ma'am.
Scott, this may be a silly question, but with the 203K, it has to appraise though, right?
All the products have to appraise. Now,
So
the 203K gives you some lift. They will finance 110% of the cost. So you look at it 2 different ways, and there's what they call the maximum mortgage worksheet calculation. And if that loan is, say you have an appraisal at X, and then you have cost that is Y, and they're not aligning, I can go to 110% of cost, which sometimes lifts me up equal to or possibly higher by a touch than appraised value. So that's an additive because FHA gives a lot of value to the fact that you're going in and making improvements, especially if they're things like they love windows and doors, anything related to energy efficiency and things like that. Yes, sir.
In your experience, what is the ROI on an investment, let's say, of 25%?
It's tough. I mean, it depends on what it is and it depends on where it is. You see it all over the board. I mean, basically what he's saying is how much value do you get for certain improvements that you put into the house. And there are certain improvements that you get a lot of value to. And then there's some that you get hardly any value to. That report that I showed you, it goes through every single thing that can get done in a house and shows you what certain items give more value to. Surprisingly enough, doors and windows are number 1. They give more value to doors and windows as an individual renovation than anything else. You're almost grabbing dollar for dollar, okay? Then you get into things like kitchen remodels and bathroom remodels and things of that nature, and then it becomes all in the eyes of the appraiser. What he thinks about it and what he doesn't think about it. Yesterday, I got this question asked to me, are we seeing failed appraisals? Okay, so where we're trying to add renovations and it doesn't appraise, doesn't even come close to appraising. And I've had it happen 3 times so far. So once was in Atlanta, Georgia, and I totally blamed the appraiser because the home was vacant. There was a squatter living in the house. He locked himself in the master bathroom, and the appraiser couldn't get in to look at the master bathroom, so he devalued the appraisal because he said I couldn't inspect the whole house. Now, if I'm a guy going out there to look at a house and there's someone squatting in the home, I get somebody out there to remove him so that I can do a proper analysis of what the home value is. He didn't do that. He just stamped it and then boom, we're done. Once you get it, once you're pregnant with it, right? You've got the appraisal and you can't really undo it now. So that one was tough. We had a swimming pool, brand new home with a brand new swimming pool, and the appraiser just didn't give enough value to the pool. This appraiser we'd had problems with before on previous transactions, so we knew it was going to be tough with him, and it obviously was. The borrower went ahead and did the deal anyway because he just put the additional money down because he really wanted to finance the house. He really wanted that pool. The only other fail I've had was a homeowner association wouldn't approve a plan. which I've never had that happen before. And I got to think that was either this guy, somebody on the board didn't like him. He was doing some exterior work, and it was on a corner lot right as you came into the subdivision. So I don't know if he was messing with setbacks or aesthetically what it was going to look like coming in. But he opted to sell the home and go buy another one and do us with us on another property, which was great, out of that subdivision. So to answer your question, it's hard to say. It's all over the board, but I think I can tell you there are many things that are grabbing significant value. There's one large one I'm doing right now in the Castle Hills area in San Antonio, where the house was $250. We're putting in $175 worth of work, and our appraisal came in at $550. And we got a significant amount of lift on that house, but it was an older home and it needed to be completely redone. We're putting a seamless metal roof on it. We're changing rooms. We're remodeling the kitchen. We're restuccoing the exterior. We're doing a lot of work to that house, as you can imagine, for that kind of cost. But the neighborhood's going through that type of redevelopment, so that's what we're seeing. So again, it's pocket areas and what that appraiser sees. Going through the products, again, we offer the full gamut. So we offer Fannie Mae Homestyle, 203K Standard, and Limited. For those of you unfamiliar with that FHA 203K business, it used to be called Streamlined and Full. Last year, our federal government decided to spend significant dollars to determine whether they needed to change the name of that or not. And they came up with new names, Limited or Standard, versus what it used to be called Streamlined and Full. Nothing else changed. They didn't really change any other parts of the loan. They changed those names and put out new guidelines. So
they didn't have anything else to do, so they decided to
I'm sure someone got a lot of money for that. I'm very confident that they did. As far as the program types, it's pretty much all residential. We do 1 and 2 units. We do second homes on the Fannie Mae Homestyle, which is a huge market for you guys with stuff down on the coast that people can do. A lot of those properties, you know, they change hands, and they change hands with the furniture, and nobody really does anything to them. There's some grab there to be able to come in and do some special things to a home or a condo and kind of get it lifted up. We do this on condos as well. Minimum renovation amounts, there is none on the Fannie Mae Homestyle. On the FHA 203K Standard, there is a minimum there of at least $5,000 worth of work, and on the Limited, there is no minimum. We do limit ourselves as far as a maximum renovation limit to 50% of the completed appraised value. So that gets a lot of talk a lot of times. What does that mean? So if you're buying a house for $100 and you're putting $50,000 worth of work in it, so now I've got a combined acquisition cost of $150, and the appraisal comes in at $150, you're fine, because the completed value appraisal divided by 2 means you could have $75,000 worth of work. You've only got $50. You got to do that calculation on a couple of these loans, so it's important to do it. We do it on our end just to make sure that everything looks right. Let's talk in detail on the FHA 203K. Again, 2 types, Limited and Standard. 30-year owner-occupied primary residence, and understand that on the Limited, it's repair or improvement costs that are $35,000 or less, non-structural, cosmetic in nature. So you're talking about flooring, you're talking about a roof, you're talking about an HVAC system. You're not moving walls, and you're not doing any addition. As far as the Standard 203K, it can be anything. The actual guideline says they can actually tear the house down to the foundation and start over again. I don't want to play in that arena. First of all, because if you're tearing a house down to the foundation, that's kind of a construction loan. And they also tell you that you have to be finished within 6 months. And I don't know that I can build a house. In certain parts of the country I probably could, but in certain parts of the country I don't think I can get one completely built in 6 months. New construction is kind of like having a baby. It's exciting in the beginning and very painful in the end. And it takes about 9 months. I mean, it really is. It takes about 9 months to get one finished. And when you're done, you're tired. You just want it to be over with. And, you know, please just let it happen. But like in the beginning, when you're looking at the plans and you're talking to the contractor and everything, and you're buying the lot, it's very exciting. But like I say, it's a 9-month process to get one of these things done. So I kind of say we want to step out of that arena and not play in the whole tearing a house down to the foundation. Now to let you move houses. I don't know about you guys, but I don't want to play in the house moving business either. You know, there's always a problem with moving a house, and that is, when do you pay for the house? Well, the guy that's selling the house and wants you to move it someplace, he wants to get paid before you pick it up and leave with it, right? I don't want to own it until it gets to its final resting place. So when it's rolling down I-45 out here in the middle of the night, one of those trucks, you know, and lights on it, and a big sign that says wide load, and somebody in a station wagon with lights on top, and they got a bottle of Jack Black between their legs that they're pulling on while they go down the road, that ain't my house, okay? That ain't gonna be my house. I don't want any part of that house. So house moving is kind of something else I don't want to really play in, so I steer clear of that. But for the most part, anything can be done on these standard 203Ks. There are what we call high LTV limit areas for FHA. I've done some like up off of a couple blocks off the Capitol in Washington, D.C., where you're talking about buying a row house for $500,000 and putting another $500,000 in it, and it's big deals. You know, this product can be used for that in those areas. Locally, it's a great opportunity for you guys. One of our highest producers is there in San Antonio with me, and we went to lunch one day, and he goes, you know, Scott, he goes, I really want to do this. You're a nice guy, and you make it sound really good. But he goes, when I first got in this business, I was 26 years old, and I walked into the office, and I sat down, and one of the realtors, loan officers, come up to me and said, hey, if you hear the word 203K, you run, because that's the worst thing that could ever happen to you. And I'll tell you that that's been the label for quite some time. Now, partially due to the guys that were in the business and kind of doing it, the people that were really aggressive in it. Wells Fargo for many years was the #1 aggregator of 203K loans in the country. They did more of them than anybody else. Now, everybody sold their 203Ks to Wells. Wells was the folks to do that. There becomes a problem when you get that big, and it's called timing. You know, everything gets slower. The machine's so big, it moves so slow. And closing dates were getting pushed and pushed and pushed and pushed. We were talking about it at the beginning with regard to what am I seeing on tracking of closing dates. How long is it taking? Well, you know, I'm tracking the RESPA application date versus the actual fund, or now what's the term, consummation? Yes, now we don't call it fund anymore, we call it consummation. So I'm tracking the RESPA application date to consummation date to kind of see if there's delays and what it looks like. It's all over the board right now. I see some folks are taking 90 days to get one done. I see some folks are taking 21 days to get one done. So after a course of time and we get enough history, I'll be able to say, is this driven to a certain part of the country? Is this driven to, for us, a certain part of the branch where we need to do some additional training or figure out what's going on? Is it driven to buyer's product or something like that? I'll know more. Right now, I really don't know any trends. I can tell you some folks are doing them in 20-something days. I can tell you some folks are doing them in 90, and I haven't quite figured out why yet. As I get more data, I'll be able to trend it. I'll be able to tell you for sure. But just keep in mind that the standard 203K, I think, is probably the better option for some of the bigger renovations. 1 and 2 unit property, yes ma'am.
I have a question. Is there a time frame that the work has to be
6
finished?
months.
6 months.
I want everything done in 6 months.
No matter what, even if it's adding a pool or...
I can stretch it out a little bit. I can get extensions on that. We actually have up to a year. It's easier for us, keep in mind, because we're keeping the loan. I mean, it's not like we're just hanging on to it during the renovation stage and then we sell it to Wells or Chase or one of those bigger companies. We keep this paper. These people become part of our servicing portfolio. We're a company that services, what is the number, almost $10 billion? Almost $10 billion worth of servicing we have right now, which are SWBC customers, and we plan on keeping this as well. So for us, it's not an issue. I just need to make sure that it's cool with FHA or Fannie Mae, make sure that it meets guidelines so that we can stay insured on it. Yes, ma'am.
And I'm sure you'll get to this, but on the standard and the other one?
Limited.
Limited.
Is there a difference in like interest rates or anything like that?
No, interest rate is the same on both products. Very reasonably priced too. When I look at our competition, okay, so as Jeff Sonathi said, I ran construction lending and renovation lending for First Horizon and then for CTX. And I was one of the last men standing at the CTX thing, so I left 4 people there when I walked out the door that day in the whole company. And I didn't want to do anything for quite some time. I was shell-shocked, right? But I went to work for Prime Lending and helped them set up this program at Prime. I consulted on them with them and helped them set it up. One of the things I argued with Prime Lending about was the pricing model on it. What they did was they charged the borrower for an extended lock to cover the entire course of the renovation period. So they're very adamant with them is how much is the work, how long is the renovation period going to be, and they charge the borrower a pickup for that renovation period. I don't like that because they're selling that loan into a Ginnie Mae security or a Fannie Mae security immediately. All of that extended lock fee is lift to them. It's just gain. That's all it is. And when we sat down and talked about the pricing on it, I said, I want it to be attractive to the customers. I don't want it to be, as Wells did, a big piece of our business. What I want this product to be is an opportunity for everybody, us, the realtor, everyone, to get one more extra deal, but to help establish those long-term relationships so that we can, you know, show our stuff, show how well we do our business, and help everybody in the process. So we don't put a huge add-on like that to it. Don't charge the borrower an extended lock. 1 and 2 unit properties, attached and detached single family, attached and detached PUDs. We can do it on condos, but it's interior work only, nothing on the exterior. And here's a funky one that FHA requires, so this one's important to hang on to, and that is the home has to have been completed for 1 year, has a certificate of occupancy. You scratch your head and go, well, why is that? Why would they care? They got burned on a bunch of homes that got like 75% built and then went into foreclosure, and then somebody comes in and buys it and finishes it, puts the flooring in, paints, and does all of that stuff. Some of those original subcontractors that liened that house, those lien rights carry on, and all of a sudden they can file a claim because it follows the house. Even though it's gone through foreclosure, many times in many states, the foreclosure does not completely wipe out the mechanic's lien rights. So if you let that 1 year exhaust, you've let those lien rights exhaust. So that's why FHA has that requirement. That's kind of a funky one for them that you always should keep in mind. There are required improvements that FHA will do when they do an appraisal on the house. They'll say, hey, if there's anything that's health or safety issue, we want it fixed. Code violations, we need those fixed. Structural defects, anything they require based on the appraiser will be the one that makes those requirements. They want smoke detectors operating, of course, in all the rooms, but they'll do that kind of stuff. We had one in Dallas that we just did. It was an FHA limited, put a new roof on, did some additional siding, rotten siding on it, repaired that. I got back all of the stuff and the final pictures on everything, and the contractor didn't replace the fascia board. The fascia boards were rotten and peeling. And I'm looking at this, and he got the roof done, he put the siding on and everything, and there was a real big disconnect between one of the words in what the appraiser said and the contractor said, and that was trim. And he said he would be replacing the trim. And the appraiser assumed the trim meant fascia. And the contractor assumed trim meant the trim around the windows that he replaced, and he was not planning on replacing the fascia. And I kind of drew a line in the sand and said, dude, we got to get this done. I cannot, in good conscience, let these people move into this house with rotten fascia boards and peeling paint. Let's get it done. So we all came to an agreement and got it done. It just got finished. Yes, sir.
So there is a possibility that, let's say, a homeowner would like to move forward and make certain improvements to the home up to the $25,000. And at the end of the day, when it gets reappraised,
We don't reappraise it. So
Well,
we base the appraisal off the beginning.
Okay, but it has to meet with the requirements of FHA.
Right.
So there is a possibility, if there are some existing defects in the home that did not have anything to do with the renovations, could keep it from being approved?
We know up front, when the appraiser looks at it and we do the review up front, we know everything that needs to be done. So we get those addressed. Like when I look at the appraisal in the beginning before work ever starts, before we even close, and I compare that to the contractor's bid and make sure we're covering all the bases as to what the appraiser said. So I review that and make sure. On that particular instance I was talking about, it was literally a misconception of the wording of trim versus fascia. We do, and we're going to go into details on it, require a contingency reserve on all of our renovation loans to cover things like that. We go ahead and build some additional cash in there in case something happens, and then if we need it, we use it. If we don't need it, we apply it to the principal of the loan at the end, and everybody gets their money back.
Yeah, let me clarify my question. Let's say that the homeowner is interested in renovating the kitchen. And so when that is done, I don't know, do they look at, let's say the house has aluminum wiring.
Right.
Which obviously will not be acceptable
right.
for FHA purposes. So that surface is in the very beginning, and it's identified and put forth to the...
In the very beginning, that's
okay.
right.
Okay.
In the very beginning.
Yeah, if they're moving a wall and they find mold behind it.
Then we use the contingency funds to go in and do that mold remediation.
Okay.
And we've run into that. We've spent some of the contingency funds for things like we did a house in Atlanta, took out the flooring. We were just replacing flooring, but the subfloor was rotten. And we had the contingency funds, and the contractor called me and said, hey, this subflooring's rotten. I called the homeowner, we talked about it, we had the money there, and we used the contingency funds to replace the subflooring, and everybody went down the road, and it was great. And in retrospect, that was a perfect example of using those funds. This was a young couple. It was their first home. They came in on an FHA loan with minimum down payment. They didn't have a whole lot of cash reserves after closing. They had good credit. They probably could have gone out and got an additional loan to finance it, but that's not really what we wanted to do with it. We used the contingency funds for exactly what they were designed to be used, and that is to fix unforeseen things. Now, I will tell you from my standpoint, if we get down to the end and we haven't used that money, and it's just sitting there, and the borrower comes to me and says, hey, I'd like to use it for something else. We didn't use it. We didn't run across anything bad. Very rarely happens. But can we use it for something else? And my opinion is, yeah, let's go use it for something else. Let's put in a new front door. Let's put in a new garage door. Let's put in something else. I have no problem with that at all. There are other lenders that won't allow you to do that, but I don't have any problem with it at all.
Yeah, to further, you're going to have your purchase contract, then you're going to have your bids of what it is that you want to repair or improve. Put that together, and the appraiser's going to see all of that upon his inspection as well. So those items.
Does the inspection report play a role in that?
No,
Okay.
just the appraiser's inspection. So again, that'll be your health and safety items. Is all the appraiser's really looking at is health and safety.
Okay.
And so he'll look at, and when they look at the two of all our bids that we're going to do, and you look at your appraisal report and they call for the rotten wood or painting, then you're going to be like, well, hey, they're not doing that. Y'all are also going to have to do this in order to meet your health and safety repairs.
So we're unlikely.
And we'll add it together. We'll say you have to add that in.
So we're unlikely to get into a situation where this process is going to call for the inspection report to be seen and then demand that.
Unless the appraiser calls for it. The appraiser sees some sagging, roofing or tiles or something, and he may call for, or she may call for, an additional inspection. But all they're really looking for is health and safety items. And it does happen from time to time where the appraiser will call for an additional inspection, but typically not.
Yeah, it's not very often. We on the FHA 203K limited, the smaller one where it's just cosmetic work, we don't even have to use the original appraiser to go out and make the inspection for us. We use an independent third-party inspector, and he completes what's called a HUD compliance inspection report, signs off on it, I sign off on it, and we go down the road. In fact, FHA says that if the work is less than $15,000, just the consumer has to tell us it's done. We don't even have to go back and look at it. I don't like that, so I always send somebody to look at it because I'm trying to protect, again, when we talked about we're keeping all these loans, I'm trying to protect our asset to make sure that it is what it was. On the large 203K, the standard, we have to engage what's called a HUD consultant and that is an agent of HUD that is in your marketplace here, and he works with the buyer and the seller and the contractor before we ever close. And he does all the inspections, he looks at the house, he does all of the reviews, negotiates on the contract and everything, and kind of oversees the project. He's the eyes and ears on the ground locally. And he gets compensated for that. It gets rolled into the loan, but he's the agent of HUD that actually on-site handles all those things.
Right. The reason that we're a little bit gun shy of, anytime you associate FHA with anything,
it always gets more complicated.
And so it has been our experience that condition of the property is frequently a big concern.
Right.
When you're doing an FHA, because you get an inspection report that is less than optimal, and then people will start, in retrospect, trying to discover, other issues that may not even exist.
Sure.
But our inspectors, and I know you know this, our masters are opening cans of worms.
Oh yeah.
And so they always refer to an expert in that field.
That's correct.
And FHA comes around and, they mention anything about the roof, they mention anything about the electrical, they mention anything about prior moisture penetrations, and it all goes awry. So
I tend to agree with you completely on big projects that are like the FHA 203K standard. When we engage that HUD consultant, he begins to go out there and start reviewing the property and doing the work. Many times we get into more and more and more, and then there becomes an argument between the borrower and the contractor and the consultant as to what should be done and what shouldn't be done. We let them all handle that and do that fine. So I don't disagree with you there, although I do think that program has its niche. The 203K Limited, where it's just cosmetic work and I don't engage that consultant and it's me and the appraiser, I tell you what, I hate to sound snotty, but some of the houses that I've seen roll through out of some of the marketplaces where we're active, I am shocked. It's like, to some of the houses that roll through out of Georgia and Arkansas and places like that, they are, small homes that were built in the 20s, where we're going in putting in a new roof. And one that I looked at yesterday at the office was they had a pink bathroom and a lime green bathroom tile, right? And we're changing the tile on the pink bathroom, but they left that green bathroom the way it was. I was sitting there looking at it going, did they like that? To fix this bathroom was $2,500. Let's fix this one over here because this is bad. But again, it was, and they redoing the kitchen. They're putting new kitchen countertops in, and new appliances, and new cabinets, and replacing the laminate flooring, the vinyl flooring with new vinyl flooring.
I have one going right now that the guy, he wanted to do about $35,000 work on this 1980s home. There's a one-story ranch. And he set up an appointment to meet with 2 contractors, or maybe it was 3 contractors, and they all no-showed him.
Yeah.
And so he was like, I think, he told me the home's older, we got all this work we need to do. And he said, these contractors kind of turned me off, so I don't know that I want to do that. And I said, he goes, so what are we going to do? And I said, well, we won't know until we send the appraiser out there and see what the appraiser says. And so I'm thinking, man, he's going to open up all this stuff we're going to have to do. Flooring. It's completely, all the flooring in the house has been ripped out. It's just concrete, and that's all we have to do to close. So, and what we're going to end up doing on that is an escrow holdback.
Yeah, which can.
Because he just didn't want to deal with it. But I was thinking, oh my gosh, what's the appraiser going to call for?
Right.
And flooring.
It's not quite as painful as it was. And again, I totally agree with you on the larger ones, that when we get into a lot of work. I've got one in Boulder going on right now. It's $100,000 worth of work. I've got one in Manhattan Beach, California going on that's $80,000 worth of work. And those deals got interesting because we found a lot of extra stuff that HUD consultant wanted done. Perfect examples of stuff that can be done. We just kind of went through the whole list. Kitchen, bathroom remodels, room additions, flooring, roof, mechanicals, which is HVAC and plumbing. Complete electrical rewires have been kind of big. We've seen quite a few of those come through recently. Yes,
Scott,
ma'am.
if his inspection came back and we needed to change the electrical and there was things that needed to be done that we didn't know about before the inspection, can that can be part of the contractor's bid?
Sure. Absolutely.
And then I guess we can find out how much it's going to cost.
Right.
To see if it would be cost efficient or if we could even do it on the 203K.
Exactly right. Appliances, FHA has no problem adding appliance packages to the home. They allow refrigerators to be added to the appliance package. So that's kind of a nice uptick there for them, is to be able to put a refrigerator in the house. Painting garage. FHA will only allow swimming pool repairs. They do not let you build a new pool. They consider that a luxury item. So as far as the pool goes, you can retile, redeck, replaster, put in new equipment. Just can't start from the ground up. And of course, anything energy efficient.
I thought you said a moment ago there was a program that you were fighting.
Fannie Mae Homestyle. Fannie Mae Homestyle will.
Are we going to go over that one too?
We are.
Okay.
Again, recreational luxury items, no swimming pools, no hot tubs. I don't agree with them on outdoor fireplaces and barbecue grills, and I know that's being reviewed by HUD as possibly being able to let those things get added. It's literally an act of Congress to get something added through these programs.
Saves them money. They don't have to go out and get salt wraps.
I know. But they are looking at that. I don't agree with it. When I bought my home in San Antonio, that was one of the things I wanted to be in the hill country, and I wanted tons of outdoor living space because I like spending time outside. So I think it's huge.
To that point, landscaping?
Landscaping they let you do on a limited basis, like fence and limited landscaping, but not anything that they consider over the top.
No vegetation?
Mm. Okay. Tennis and sport courts, they also say like murals can't be done, things like that. Contingency reserves we talked about. I don't let borrowers do any of the work themselves. They have illusions of grandeur. It's kind of like me when I watch HGTV. I get excited and want to do stuff. I'm not qualified to do it, and I generally break things, and then it costs more money to get it done. So let's let borrowers and buyers go do that little thing that we use to qualify them for their loan, their job, and let's let us and the professionals worry about this kind of stuff. No changes to the project after we close without letting me know and letting me sign off on it. All right, let's run through the Fannie Mae Homestyle program. It's the Fannie Mae loan, of course, and it's a little bit less difficult than the 203K, a lot more user-friendly. Essentially, we can add and do anything to a home that we want to do. There's absolutely no restrictions on it. It only has to appraise and be common and customary for the area. So swimming pools, room additions, outdoor fireplaces, outdoor kitchens, anything you want to do, it's just got to appraise. Fannie Mae was in our office last week and we were talking about it and walking through, doing the walkthrough on it. Very exciting stuff that Fannie Mae's come out with, but they kind of give us carte blanche to do whatever we really want on this program. As a side note, with Fannie Mae last week, and don't broadcast this too publicly, but we had the chief credit officer from Fannie Mae, our account rep, several of the key people. We are in line to be on the Fannie Mae beta test for construction lending. So we are like going to be one of the only ones that get to do that out of the gate. So I hope to have something on that to be back to talk to you guys about possibly doing new construction, which we'll all be suffering through 9 months of having a baby.
Then we can do land loan.
On the eligible properties for the Homestyle, again, 1 and 2 unit primaries, 1 unit second homes, detached and attached single family, detached PUDs, condos, as long as it's interior only. Again, Homestyle is a really cost-effective way for the borrower to add the improvements to the home. It just has to appraise, it has to add value and be common and customary for the area. No restrictions on what can or can't be done. They're weird on appliances though, okay? Fannie Mae won't let you have in your appliance package a refrigerator, washer, dryer, or a stove. Okay, that's stupid. But
microwave? I mean,
yeah, right. But they won't. Dishwasher's fine.
Yeah.
But you can't have a stove, which I think is just insane. They won't let that be in the appliance package, and that's one of the things I look at. So when the bid for the appliances come in, I look at if it's got a stove in there or not, and if it does, I have to pull it. So just be cautious of that. Again, no do-it-yourself work, no borrow. I had a realtor ask me the other day if they could do some of the work. I don't understand why you would want to be in the middle of that. I would get my money and leave. When you leave the title company, get your check and don't look back, okay? Do not be over there painting rooms or doing anything like that. That is a license for disaster. We also get a lot of people that ask us if a family member can do work. Okay, so here's my spiel on family members. First of all, I get it. If my Uncle Billy Bob was a contractor and I was buying a house, I would want him to do the work. And on those cases, I'll look at them on a case-by-case basis. But here's the problem. Uncle Billy Bob better make me a fantastic deal on that because he's my uncle. And I have to look at it from a lender's standpoint. If Uncle Billy Bob can't do this job because he gets too much work, he gets hurt on the job, God forbid he dies, I have to go hire somebody else to do the work, and I've only got so much money to pay somebody to do this. So even if you want to demand Uncle Billy Bob has to do the work, I'm going to look at it and I'm going to make sure his bid's for enough that if he can't do it, I go find somebody else. So it doesn't really become super advantageous and generally leads to huge family feuds over the course of time. I will tell you, from as far as contractors go, we review the contractor qualifications of every contractor that comes into our deal. I want to make sure that the contractors that are out there doing the work are good contractors for our customer. When I say our, it's your buyer, it's our borrower. I want to make sure that they're good people. So we run background checks on them. We look at how long have they been in business. Do they have any judgments from customers where they didn't do good work? Do they have liens from suppliers that they didn't pay? Do they have a federal tax lien from the IRS? I look at all of that stuff. I look at their criminal history. I see if they've got felonies or misdemeanors or anything like that. Let me tell you, that's where we get most of the noise, is from that category. And then we have to make a decision because, first of all, I can't go to your customer and say, hey, he's got a felony. You don't want him in your house because that's his personal information. So I have to play a little dance and say, well, this guy's got something going on, are you sure? And dance around it a little bit. But we look at them to make sure they're pretty decent guys. And if there's certain things like a federal tax lien, I'm going to have to always pass and say I can't do business with him because federal tax, I'll put money in their account and the IRS, if they're watching, they'll seize it. And then the money won't be there to finish the work. So we'll always be watching for that kind of stuff. But again, the contractor review process is pretty simple. It takes 3 or 4 days to get them done. I would also urge you not to refer your customers to particular contractors. I know you always have a desire to do that. You've got a contractor you know, he's a good guy. I have seen litigations where a realtor or a mortgage professional referred a contractor to a customer and he failed to perform, and the customer came back and said, he told me to use this guy. And generally it's a he said, she said kind of deal, and we kind of get out of it unless they pull that nasty thing up called an email, which lives forever. And then they go, look, Judge, he said use this person, and then everybody starts writing checks. So I would urge you, if you're going to refer a contractor, just refer 2 or 3. Just always put it in the customer's hands and give them more than one to actually look at. Conversions we don't permit, so example would be taking a 1 unit to a duplex or something like that. So we don't allow that as well. Conforming loan limits to 417.
Sorry, could I address a bit regarding contractors again?
Mm-hmm.
So is there a published list?
We don't publish a list because I don't want people to pass it out. When a contractor is qualified to participate in our program, they're good for 1 year. So they can do multiple transactions in that year. In fact, we're actually rolling through getting second deals with certain contractors. The contractors have been so great. They get through the process and they go, wow, this was so much easier than I thought. They'll bring us customers, which is fantastic. We love that. But what we try to do is just not steer them towards anybody particular.
So is there a source where you can actually go and look for potential?
Most of the best place I think to look is the National Association of Home Builders. Their website gives you a list of contractors that actually are members. Costs money to be a member of the NAHB. If they're going to spend the dollars to become a member, then they usually are a reputable guy. What I try to do is, and what I ask our company that does the outsource for us on the contractor review, look at their Better Business Bureau rating. That's a huge one because, you know, people complain, but like, just Google search their name. I mean, we had one here in the Houston market. He came up, his contractor review was a little dicey, and he had a couple of felonies. They were old, you know, and at the time I was looking at his age versus that. He was 21 when he got his first felony. It was, you know, almost 15 years ago. He'd kind of been clean since then. I got on the Harris County Court website, pulled up the case, looked at it. Him and a bunch of buddies were at a bar. They got in an altercation. He beat somebody up. He took a plea deal. Paid $400 to a fine and was on probation for 6 months.
Sounds like a good contract.
But it's a felony, right?
Kind of guy you want.
That's one of the better
Get stuff
ones.
done.
It was in Highlands, Texas, which is, I assume it's not too far from where we're at.
Highlands?
Yeah.
Maybe that's Dallas.
That's Dallas.
Is it? I don't know. But I was looking at it and I was like, and the guy was a roofer.
That was the problem. He was up in Dallas. He shouldn't have been up there.
And it was like a roofer, and I was like, well, you know, this isn't that big a deal. And we went ahead and went with it. The guy did a great job, got the job done in 45 days and was in and out. So when we look at them, but it can be pretty dicey when you get that stuff. That's just the way that field is,
So
unfortunately.
it's okay for us to perhaps go to the Greater Houston
Absolutely.
Builders Association?
Absolutely. Yeah, absolutely. Contingency reserve we talked about. As far as the percentage on the contingency reserve, I always want 10%. And that's 10% of the work, not 10% of the sales price of the house, not 10% of the loan, 10% of the work. If they're doing $25,000 worth of work, I want $2,500 to be able to hang on to. Now, that's if the utilities are turned on. If the utilities are turned off, I'm going to want 15% because you just don't know. When the water comes on, man, it can look like one of those, you know, boats out in there when they're fighting fires on the water and water's just spraying out of the boat everywhere. A house could actually look like that sometimes. So if the water's not on, I kind of want 15%. On swimming pools, I don't want anything. If it's a pool, I've built 3 pools in my life for myself. I've done hundreds of them in the renovation and construction world. Pools generally never go over budget. The only reason a pool goes over budget is if the buyer decides they want to add something. You know, at the end, oh, we want a wet bar in the pool, or we want this, or we want lights that go on to do this stuff. I mean, that's when costs get added to a pool, and that's their dollars, and if they want to do that, they can spend it. But I generally don't see pools go over budget, so I don't require any kind of contingency reserve on that. And that is all. Questions?
You might want to mention if they don't use the contingency
Yeah, on the
reserve.
contingency, if you don't use the money, we apply it to the principal alone and go on down the road with it. If they want to use it on something else, like we discussed, I'll let them use it on something else, as long as it's an allowable thing to be able to use. So if they want to use it for, you know, I can't let them, like on a 203K, use it for an outdoor fireplace or something like that because it's not allowable in their program. But I can let them use it for a new front door or new, you know, garage doors or something like that. Yes, ma'am.
We don't do a whole lot of FHA, so remind me what the limit is here.
337. Yeah.
I thought it was 326.6.
No, it's higher than that,
No.
Mary.
Is
last
it?
year.
Okay.
Well, it does vary around the Houston area now. It just went up, but yeah, 330.
Okay. It was 326.6 a couple months ago.
So, here?
Yeah.
We were hoping for a lift on the conforming side, but we didn't get it. But who knows if we will in the future. We're working diligently on rolling this program out for jumbo products. So if I get closer down the road on that, I'll give you all some speed on that. It's a little different on a jumbo loan, primarily because on a jumbo loan, where these loans I get to get Fannie Mae and FHA insurance day one, you know. On a jumbo loan, I got to hold it in a warehouse facility and manage the borrower's payments during, you know, their P&I payments during the actual renovation phase, and then I sell it to the aggregator at the end. So it's a little bit different, but we'll get there probably pretty soon.
Thanks.
Other questions? Wow, that was good. Well, all right, guys, I appreciate you coming out. Again, touch base with our local office here. If you have any questions or concerns, you're always free to reach out to me directly. I'm fairly accessible. My deal is kind of like this. If you ask me a question, I'm probably always going to tell you exactly what it is up front. If I don't know the answer, won't make it up. I'll tell you I don't know the answer, and I'll go find out, because that's kind of what I expect when I deal with people, and I try to in turn do the same thing. I can't promise you that every deal will be perfect, but I can promise you we will try as hard as we can. So y'all have a great day. Thank you.